Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Tuesday, January 7th, 2026, and Wall Street finally exhaled. The S&P 500 snapped its short win streak after tagging fresh highs. The Nasdaq still squeezed out a small gain, but the Dow took the real air pocket. This wasn't a clean risk-off flush. More a rotation with friction, where leadership narrowed and the market tested how far record levels can stretch. Under the surface, the heat map looked tired. Bright green clusters in big pharma and a few AI platforms, surrounded by wide swaths of red in banks, energy, industrials, and even some staples. Tech wasn't one solid block either. Alphabet and a few AI names were in the green, while Apple and Meta faded. At a glance, it was clear. Money was hiding in select winners, not embracing the whole market. That backdrop builds a clear tension. Indexes are still hovering near records, but fewer groups are doing the heavy lifting. Financials are rolling over. Housing-linked names and energy are struggling. Classic defensives like staples don't offer clean cover. So capital crowds into AI platforms and big healthcare instead. Heading into productivity numbers and Friday's jobs report, the Tate feels more like a stress test of this narrow leadership than a broad de-risking. One piece of color on the day's healthcare strength was Eli Lilly. There was chatter about potential acquisition activity around the name. To be clear, that's rumor-level talk, not confirmed news. But it added to the buzz in a sector that was already a standout green patch on the screen. For now, it's something desks are talking about, not a fact pattern investors can rely on. JPMorgan was front and center on the downside. Big money center banks sold off, helping pull the S&P and especially the Dow lower. On top of the broader financials fatigue, housing-linked names reacted to new policy talk around institutional ownership of single-family homes. For JPMorgan, the message was simple, as a bellwether. Its weaker tape echoed the market's hesitation about leaning too hard into rate-sensitive and cyclical exposure right before major labor numbers. Blackstone was another weak spot. Alternative asset managers came under pressure alongside the big banks, as investors pared back exposure to credit and private markets plays that had run into year-end. That move doesn't point to a specific new shock, but it does keep questions about private asset valuations and leverage in the conversation. In a session where financials broadly lagged, Blackstone's slide reinforced the idea that risk-heavy corners of finance were being nudged lower first. Alphabet was one of the day's clear winners. The stock outperformed the broader mega-cap complex, helped by ongoing enthusiasm around its AI work and search monetization. That strength, alongside other AI-linked names, helped the Nasdaq stay in the green even as Apple and Meta traded lower. With indexes leaning more heavily on fewer leaders, Alphabet's solid tape underscored how central scalable AI platforms have become to keeping growth indices afloat. Microsoft's move was quieter but important. The stock managed a modest gain, extending a steady grind higher that's been anchored in cloud and AI demand. On a day when financials and other cyclicals weighed on the Dow and the S&P, Microsoft's resilience mattered. It showed that large pools of capital still feel comfortable parking in mega-cap software and AI, using names like Microsoft as ballast while they trim risk elsewhere. ExxonMobil traded lower, part of a broader energy pullback. Crude prices slipped, and Venezuela-related headlines added to the pressure on the group. On the S&P heat map, integrated majors like Exxon were solidly red, reinforcing the sense that the market was taking a step back from some of the most cyclical commodity exposures. That weakness in energy sat alongside softer metals and silver, hinting that today's caution wasn't confined to equities alone. Apple moved the other way. The stock finished in the red, continuing a softer stretch tied to questions about iPhone momentum, regulatory overhang, and a slower-moving AI product story. On a day when Alphabet and Nvidia helped keep growth indices afloat, Apple's underperformance stood out. For portfolio managers, that makes Apple look more like a potential funding source than a core AI leader, and it underscores the growing winner versus laggard divide inside big tech. Looking ahead, the macro calendar is front-loaded. Productivity and labor cost data hit next, followed by Friday's non-farm payrolls, the unemployment rate, and wages. Recent readings on job openings and private payrolls have been mixed, keeping traders from leaning too hard in either direction. Treasury bill auctions and ongoing Fed communications round out the backdrop. Together, they'll help decide whether the soft landing and eventual rate cut narrative keeps supporting equities at these levels. Positioning into those data points looks selective. JPMorgan now sits at an important short-term zone, sensitive to any shift in yields or credit tone. Alphabet and Microsoft remain primary hiding places if the market keeps rewarding scalable AI platforms. ExxonMobil's next move will track both macro growth signals and any fresh geopolitical headlines. And on the higher beta side, Palantir is quietly consolidating, leaving it ready to move once the next AI software or macro cue hits. To wrap up, the rally's still standing, but it's standing on a thinner platform. AI-centric tech and big healthcare continue to carry more weight, while banks, housing-linked names, and energy absorb most of the selling. That's the rotation with friction story for now. The next few data prints will decide whether this narrow advance can broaden out, or whether the market finally needs a deeper reset. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.